Morning, everyone. Thank you so much for taking your time out on a Saturday, and I'm sure this is going to be an interesting conversation on a Saturday as well. Uh, let me before I introduce our speakers for the day, let me just quickly introduce Lawbit to you. While most of you are aware of us, but just a quick 1 minute introduction. I'm Jyant Kohli, the founder and CEO of Lawrbit. Lawbit is offering SaaS-based risk and regulatory compliance management solutions, which has a global integrated regulatory intelligence. So if your business is looking for a regulatory compliance solution anywhere in the world, we are your go-to partners. We can serve you anywhere in the world. Today, we are serving around 250 legal entities across 70 plus countries, 1,200 plus locations, and we have a team of lawyers and company secretaries who are backing us and building all the regulatory know-how, building all, keeping it updated on a real-time basis, and also backed by very strong processes and teams of who are supporting our clients post go live, which has also helped us retain all our clients over the last so many years, which is a great mark in this industry where normally people start losing the interest in the compliance solutions. So if your organization considering a compliance solutions, we are here. Feel free to speak to us. Uh, with this introduction, I'm moving on to introducing our guests for the day. Ankita. So, Vivek. Vivek.
Hi, Jyant.
Hi, Vivek. All right. I could see you, so I was. Your
Can't
Thomas
see
meeting is
me?
on. All right. So I'm sure many of you would already already know Vivek. Vivek is a known face amongst the company secretaries for sure. Vivek is company secretary and legal counsel for one of the leading logistics company in India, which is also listed company and a name which you all have heard of. Vivek has 17 plus years of experience across different sectors, be it logistics, infotech, airports, hospitality. That's and most of the companies he's worked with have been listed organizations. So he brings a lot of such experience with him. He has in his experience have as you know he's a legal counsel. So M&As on to FEMA to corporate restructuring, IPOs, or contract lifecycle to compliance, corporate governance. He has handled everything. Yes, we can kiss you now. Welcome, Vivek. Thank you so much for taking your time out and to agreeing to share your thoughts. One thing I want to add to Vivek, we were doing a bit of discussions on this topic and the nitty gritties and the real life examples which Vivek has and he comes up with that makes the topic so interesting even for a person who's a non lawyer background, a non legal background. So Vivek, I'm very excited to hear from you today. Thank you so much. And when very thing very clearly which I want to spell out is.
So am I.
I want to very clearly, spell out is today. Vivek and Thomas, they both represent, they're part of it. There are some organizations, but the views which are getting discussed, they're all basically their experience and understanding of the subject. It does not reflect in any ways the views from their employers and the companies they are associated with, and it should not be taken as any legal opinion. Yes, this is all knowledge sharing and experience sharing webinars, and we should all take it that way. Uh, Thomas, uh, Thomas is a good old friend, and Thomas and I know each other for many years now. And again, he's a known face in the market. I'm sure, specifically people who are from the northern side, you would all know Thomas. He comes with 16 plus years of experience. in the industry. He has worked in diversified areas. Today, he represents RateGain, and he's a VP Legal and Company Secretary for the RateGain, managing their legal department for globally as well. And he has been working since the time I know. He's been working with the listed companies, large ones, and he has been instrumental in bringing the IPOs in a couple of companies in his experience. And one thing I want to talk about Thomas is that he goes into the nitty gritty of the subject. Um, uh, you know, uh, whatever you see about Lawbit, I would give a lot of credit to Thomas as to bringing us to the bringing the best out of us. He has always been somebody who is very demanding, who goes very deep into the subject, uh, and when he goes out into the subject, it is more from a perspective of a constructive learning from both. And post those discussions with Thomas, I have always learned. And I said, and I have always loved my discussions with Thomas. We argue, we discuss any subject, but end of the day, these are all learning. And I'm sure Thomas, today's your knowledge and experience on this subject would add a lot of value to all of us. Welcome, Thomas.
Yeah, thanks, Jen, for those kind words. And I'll try my best to add value to this discussion. And it's been always a pleasure being associated with you. Thank you.
Thank you so much. I'm sure it will. Ankita, next. And also, I'm introducing my colleague, Mayank. Those of you who have worked with Mayank would all know Mayank. Mayank leads the implementation team with Lawbit. Lawbit. He's an expert on companies like SEBI, RBA laws, company secretary and lawyer himself, and MBA as well. This is one of his favorite subjects. So, Mayank, over to you now.
Thanks, Ed.
Yeah.
Very good morning to all. So today in this webinar, we are going to cover and discuss recent SEBI LODR amendments. We'll touch upon the background and the timelines of these amendments, the key takeaways from these amendments. So we have covered various regulations as maximum we can, basis the criticality and limitation of time in mind. So what are the regulations we are covering in this webinar? I would say there are two set of amendments. Ones which are introduced for the first time in SEBI LODR, that is approval of shareholders once in 5 years for non-rotational directors or those with a fixed term of more than 5 years pursuant to Regulation 17(1)(d). Approval requirement for special rights given to the shareholders, filling up vacancies in the office of key position holders like compliance officer, CFO, directors, managing directors, whole-time directors in timely manner, enhance corporate governance norms by disclosing cybersecurity incidents, and further for top 100 listed entities, they have to disclose BRSR core 9 parameters. Approval requirements in case of sale, lease, or disposal of an undertaking outside scheme of arrangement. So these are the fresh amendments. The second set of amendment in the existing provision of the SEBI LODR, which we're going to discuss, that is pursuant to Regulation 30, which is a hot topic in discussion nowadays in corporates and between the professionals. So SEBI has amended Regulation 30 in such a way that each and every material and important information or event should disclose to the stock exchange. Entities have to disclose such events and information within the timely manner as specified by the regulator. Regulator had provided the guidance circular that the information can be said material and determination of the materiality of events. From recent events, regulator had brought an important amendment to disclose by confirming or denying or clarifying any market rumors reported in the mainstream media. Next. Okay, so about the background and the timelines. SEBI had issued various consultation papers, one in November 2022 and in February 2023, for amending the SEBI LODR regulations. The consultation papers proposed amendments in the disclosure requirements for material events under Regulation 30.
Mike, sorry, I guess we are getting messages that this PPT is not visible to participants. If you can get that checked, please.
Ankita, if you can check, please.
At my side, I'm able to see the PPT.
Yes.
Yeah, I guess as speakers, we are able to see, but the participants are not. I guess, yeah, now there is a message that is visible.
Okay. So I'll take this slide again. So we'll discuss about the background, the timelines about of these proposed amendments. So SEBI had issued various consultation papers, first in November 2022 and second in February 2023, for amending the SEBI LODR regulations. These consultation papers, these consultation proposed amendments in the disclosure requirement for Regulation 30, relating to shareholders agreements, approval for special rights and the board positions, sale of undertakings, filling of casual vacancies of directors and KMPs, etc. So the proposed amendments were approved by SEBI in its board meeting dated March 29th March 23. Wide notification 14 June 23, SEBI had amended the listing regulation incorporating the proposed amendments. So and SEBI had brought a master circular consolidating all the circulars till 30th June for compliance with LODR, where they have clarified various procedures to comply with the SEBI LODR regulation on July 11th. On July 12th, SEBI had come up with the revised format of BRSR and the timelines for BRSR core 9 parameters. On 13th July, SEBI had introduced guidelines for disclosure of material events and information pursuant to Regulation 30 and 30A. Now, the key takeaways from this webinar and from these proposed amendments basically is to enhance the corporate governance framework by adding transactional-based disclosures, further restricting key items which would require prior shareholders' approval, vast list of disclosure of events and information, stricter timelines of disclosures, to report and respond any event and information being reported in mainstream media with clarity, denying or accepting the same. So these are the main key takeaways from this webinar, and I hope we'll discuss this in detail. So now our speakers will take up these matters in detail. I would request Mr. Thomas to take this webinar ahead. Over to you, Mr. Thomas.
Thanks, Mayank, for the wonderful introduction. I'm hoping that the presentation is visible for the participants. I would request, in case it's not visible, if you can rejoin. That might help solve the issues. We will proceed with the first. So here we are not covering the entire changes because a lot of changes have come in and it's not possible in the short while to cover everything. We are trying to cover the key changes. One of the key changes which impacts our day-to-day interaction with our management is the change in continuing directors or approval for continuing directors. So now we need to understand why, what is the requirement under Regulation 17(1)(d). So it clearly says that for directors who have been with us for more than 5 years, we need to go back to our shareholders post 31st March 24 and get the approval from the shareholders in the first general meeting, right? And if you look at the logic, they've provided the exceptions also there. They've exempted the full-time directors because for them, the tenure is fixed for 5 years. They've exempted, Ankita. Yeah, Ankita, I guess presentation is not visible. Yeah. So basically, they've exempted those directors for whom we already take approvals from the shareholders. So like full-time directors, MD, manager, independent directors, directors retiring by rotation. All these resolutions are put up to the shareholders and it's for a fixed tenure, right? And in case of retirement by rotation, generally it gets like once that resolution comes for approval once in every 3 years. That's the general scenario. Adding to this, there is an exemption even for the nominee directors as well. So these are the exemptions they've covered. So why they've brought in this provision is to cover those directors who are kind of permanent directors, primarily promoters and non-executive directors, who might not have been placed before the shareholders for approval or have been approved, say, 8 years back, 10 years back, and they want every director to go through that process. So this kind of mandates that approval process through the shareholders, and which is a good governance and welcome move here. Vivek, I would request if you have any further thoughts, you can add here. Feel free to add your thoughts around the slides as we go ahead. Right.
Sure. So, as from the industry perspectives, this particularly will impact those directors who are holding permanent seats, those who are ex officio directors on the company, lifetime chairpersonships. In many marquee companies, we see those features. And now the purpose of SEBI to bring this amendment is to go to the shareholders asking for their consent for all such kind of directors.
Absolutely.
Yeah.
So basically, they are plugging the gap wherein shareholder approval was not required in certain cases.
Yeah, and very interestingly, the rotationally retiring director, which anyways we approach shareholders for their approval periodically. The whole-time directors, managing directors, the executive directors basically on the board, they are also exempted from this particular aspects.
Correct. Absolutely. Ankita, we can move on to the next slide, please. Yeah. Now something similar has been done in case of the shareholder special rights. Now you might ask, what are these special rights that we are talking about? These are primarily all those who have been with a startup ecosystem or who have seen the transition from an unlisted entity to a listed entity would know this, that whenever there is a fund infusion from investors, generally they enter into SHAs wherein special rights are granted or created in favor of those investors or in favor of the promoters. So such agreements give rights with respect to, in some cases, veto, some special approval rights. There is ROFO, right of first offer, right of first refusal. There is drag along rights. So all such rights are provided as part of that agreement. They are built into the articles as well. Even at the pre-IPO stage, post-IPO, generally those are put forward and taken approval from the shareholders. Now they are taking it one step ahead and asking the companies to take that approval every 5 years, right? Because in many cases we have observed those rights stays even when the shareholding of the concerned shareholder to whom, be it promoter or otherwise, to whom that special right was granted, falls below a very low threshold. So you would see such rights being extended to a certain section of shareholders, even when they hold as low as 5% of shares, which is very low when compared to the total shareholding of 100% or the public shareholding. So I guess the idea behind this is to cover that gap and to go back to the shareholders every 5 years and seek their consent whether they wish that right to continue or not. And it empowers the shareholders, which is a good governance practice again, or initiative from SEBI's side. So now what we need to do, that's the point to discuss, that it's once in every 5-year approval. In case you have an existing right and the company as on the date of enforcement of these provisions, that is 15 July 23, then you have to take the approval within the 5 years from enforcement of the amendment. So that is on or before 14 July 2028, you would be required to take the necessary approval. There are further exemptions to RBI registered financial institutions or debenture trustees registered with SEBI, with whom we generally have the lending arrangement. Yeah. So we move on to the next provision. Again, something which we would deal with on quite a regular basis. That is any vacancies in key positions within the organization. Compliance officer is like largely, I guess, most of us on call are either company secretaries or compliance officers of respective companies, or being part of that team. We would be aware that now this provision has come in wherein they want the compliance officer to be a qualified company secretary, because what we have observed in practice is many a times when there is a resignation in the office of company secretary, in the interim, many companies fill it up and maybe make the CFO as the interim compliance officer, right? We have seen that practice in the past, and kind of that is being curtailed here because they have clearly specified that even the interim position needs to be filled in with the same qualification as prescribed under the regulations. So that pretty much sets the tone for what SEBI is looking for. They don't want any gaps in compliance. They have entrusted the company secretaries with the responsibility of ensuring compliance with every applicable law overall in the company as well, but in particular the SEBI regulations or the LODR regulations. So
Thomas, are these timelines aligned with the Companies Act 2013?
If we look at the we are using the word key positions, and not everyone mentioned is a KMP, but generally if we look at the KMP provisions, what we see is a 6 months timeline under Companies Act. So basically LODR is making it more stringent, right? It is basically reducing that timeline to 3 months, right? One word that we even see missing here, or one designation that we see missing here, is of a company secretary. So in case of a compliance officer, it clearly specifies 3 months, same for director, CEO, MD, WTD and manager, as well as the CFO. But what about the company secretary? So if we look at the specified provision under law, we only have the Companies Act provision, which says 6 months. Now, the question that would come up practically before us is that can we do 6 months, right? So, like my take on that would be that we have to go by the spirit of law, right? When they've included the compliance officer and they've placed it as qualified company secretary as the qualification, we should read it holistically and should try to follow the same practice for the company secretary as well. In most of the cases, this question would not arise because the position is held by the same person. But there could be exceptional circumstances wherein the position is held by more than one person. Vivek, your thoughts?
Yeah, absolutely rightly pointed out, Thomas, that the company secretary apparently looks like is not getting covered over here. But indirectly, see, the compliance officer is back to back mandated to be a company secretary, and compliance officer office has to be filled up within 3 months. And as Thomas rightly pointed out, company secretary himself is the compliance officer. Then there is no choice for any listed company. They have to fill up the compliance officer position within 3 months time. Only in rare companies, those who have split positions, who have joint company secretaries, one is the company secretary, other fulfills the role of compliance officer. Therein, there can be two views. Company secretary's position can be filled up as per Companies Act, which is 6 months. Compliance officer anyways has to be appointed within 3 months time only. But I see a practicality is that company secretary and compliance officer, they hold the same position, and it is practically 3 months for both of them.
So Thomas, in case of vacancy existing as on the date of notification, what will be the timeline available with the listed entity?
So because these provisions have come in now, so suppose there was a vacancy in the month of April, we can't have a retrospective applicability of these provisions. So we should read it from the effective date, and the compliance timeline would be 3 months from the effective date. That's my take.
Right. Yeah, I agree with you, Thomas. So those whose vacancies are going on, their timeline would start from 14th of July. And from 14th of July, or from the date of their original, if 6 months from the date of original vacancy, or 3 months from 14th July, whichever is earlier, that becomes their timeline.
Okay.
I have also noticed in many I would say small organizations or mid-sized organizations where CFO is also a company secretary. So in the interim, if a compliance officer resigns, can a CFO take, being a company secretary, can take up a role of a compliance officer as well? So he can play a, we are a dual hat for the time being.
So couple of aspects on that one. We'll have to read Section 203 of the Companies Act along with the LODR provisions. Section 203 clarifies that one person should be holding one position. And in the interim, though that LODR permits that the due process be followed and the due qualifications be followed for interim appointments. So I think that gap can be filled up by any other profile who is also a KMP in some other position. But ultimately, within 3 months, you have to fulfill the whole the vacancy as per the strict prescription of the law. Your point, Thomas, on this one?
Yeah, I totally agree with that. I guess just to clarify, as a straightforward answer to Jyant's question, as you mentioned that CFO is also a qualified company secretary, and that being the criteria specified under the LODR regulations, he can take up that interim role. In the meantime, the company would be able to fill up the vacancy as per the provisions.
Okay, thank you so much.
Yeah. Now we move on to the changes with respect to the corporate governance aspects that have come up. Primarily, cybersecurity is a you can say something which impacts all the companies now that we are more focused towards data. Now we are moving on to AI. As far as these are helping the organizations in a larger way, it is helping us in our day-to-day lives. It exposes us to the risk of cyber threats as well, right? Now, regulators realizing this have added this provision wherein they want us to disclose every cyber threat or incident or loss of data that have happened during the quarter in the quarterly corporate governance report, right? And certain is a entity that looks into these guidelines, which is taking care of how these provisions would be implemented or how a company needs to respond to these situations and even report these situations. Those guidelines come in from certain. Certain is nothing but Indian Computer Emergency Response Team, which is set up by the government, which would look into this. So these are the guidelines that we as a listed entity need to follow. So we need to report to SEBI as well as follow the certain guidelines for reporting to the concerned department. Obviously, it goes without saying that we need to take the respective corrective action or mitigating action at our end as well.
So Thomas, it means Thomas, it means listed entity has to disclose the cybersecurity incident to SEBI and to certain simultaneously.
No. So here it is talking about reporting to SEBI in a corporate as part of the corporate governance report. But we need to look at the Schedule 3 provisions as well, whether those are getting covered, whether such an event could be material for a company. Suppose, for example, yours is an IT company, right? Wherein there is a storage of data, right? That data is lost, right? That could impact your business, right? Then you have to disclose it. Certain has guidelines of specifying the clear timelines as within which you have to disclose to the government, right? So SEBI disclosures would fall from the LODR regulations, right? This is an additional disclosure as part of corporate governance, and certain guidelines would be disclosure to the government.
Absolutely, and there is a two-pronged approach to look at it. One, as Thomas rightly pointed out, from materiality concept. So if there is a data breach, and obviously such data breaches may be emanating most of the time from outside of the organization. So within 24 hours, if a company has to apply a judgment whether it is material or not, and if it is, then it has to be disclosed to the stock exchange within 24 hours. And then in the quarterly corporate governance report also, we have to give an affirmation about this or non-happening of such incidents. And it has far-reaching back-to-back effect on the organizations internally, wherein the compliance officer will have to very closely work with the IT team, IT security team, cyber security team, and there can be periodical affirmation assurance mechanism that can be built up, that many organizations, including one that I'm associated with, we have built up. And there is a detailed checklist, not only from the IT Act 2000 perspective, but from guidelines. If you are operating within Europe, then the respective data privacy laws of the European Union or of South America or North America, these are very stringent, and some of these continents are far ahead in promulgating cyber securities law, and they are very proactive in maintaining security of these data, online data and all. So if you support any of these countries, these laws apply to such entities also, and we have to be very careful in analyzing if there is any such incident, and if there is, we have to make reporting to the stock exchanges.
Absolutely. I guess just to add to that, like when we have interaction with our colleagues based out of these regions, say EU or UK or US, they are far more concerned about their own, even their own personal data security than like I would say the response that we get from our Indian counterparts.
Right.
So because there the law has developed beyond where we stand today. Right, and they are far more sensitive about it. So it's more it's a concern world over, but good to see that even our regulators are taking note of it and specifying the relevant provisions as well as requirements to the companies, so that we take necessary steps at our end as well with respect to disclosure and timely action regarding cyber incidents.
One more interesting aspect to this one, which I looked at on the chat also, said there's a question also. While we apply two-pronged approach to any cyber security incident, if it is material, then an immediate reporting is required. And if it is not an immediate, it's not material and does not require immediate reporting within 24 hours. And nonetheless, it has to find its place in the corporate governance report in the quarterly reports. So non-material events, all smaller ones, has to be listed down in the corporate governance report. Or if there is none, we have to affirm that.
Correct. Absolutely. Sure. So with this, I'll move on to the second part of this slide, which talks about high-value debt-listed entities. This is a smaller change. I would say it's just an extension of timeline. Earlier, the timeline for compliance with the corporate governance requirements for such entities was 31st March 23, which now stands extended till 31st March 24. So I would say this is a smaller change. Moving on to the third section, that is on BRSR and BRSR core. So I guess you all are aware, and most of you might have even prepared the BRSR report this year, because it is applicable to top 1,000 listed entities now, right? BRSR core is more like I would say it's a recent concept which came from SEBI, right? BRSR core covers around 9 key performance indicators which have been specified by SEBI, wherein it requires certain entities as per the threshold to fulfill or basically get an assurance or an external audit on those BRSR core parameters. So as per the SEBI would spell out the timelines, but as per the documents released by SEBI earlier, I guess in March, they had specified that 23-24 it would apply to top 150 companies. Next year, that is 24-25, it would apply to top 250. 25-26 to top 500, and 26-27 onwards top 1,000 companies. They've also mentioned about adding these requirements to the value chain partners on a compliant or explained basis in a phased or timely manner, right? Value chain is nothing but all those activities which are covering your product or service, either upstream or downstream. So from its conception to end use, that is the value chain. So if you have your value chain partners and you're falling within those criteria, you have to explain regarding the compliance for them as well, or ensure that you are complying with such disclosures.
So
Thomas,
one aspect on this.
Yeah,
I
Vivek,
will
please.
take this up. Yeah. So one aspect on this one, similar to how CSR implementation gradually progressed in India, wherein first it was brought out very mildly, and gradually the focus of the government is shifting, and from comply to explain era, we are now into a strict compliance era. And this has far-reaching impact on the society, wherein society is getting benefited. The company is founding a purpose. Companies employee engagement has increased. They are now having a more satisfying work life. And from that perspective, and it is very important to note that the value chain partners also getting covered, because these are applicable to listed companies, and to broad base the applicability to further encompass larger number of organizations. The value chain partners are also being pulled into this one. And what do you think initially? Are the large value partners will be involved, or is there a threshold? How is this going to be rolled out?
So basically that clarity is yet to come from SEBI with respect to the threshold and all. What SEBI has like conveyed till date is the phased manner of implementation. So they've said, okay, the top 150 companies would be required to report on their value chain partners from say 24-25, top 250 from 25-26 and going forward. So what is because SEBI is not clarified yet on the value chain size. I'm sure that would come up in future, because that's why when these changes were introduced as amendment, they've not specified anything there. They've not even specified the timeline for BRSR core implementation, right? They've mentioned it there as a requirement that it would be, if I read the exact wordings that they've used, what they mentioned is shall be obtained and with effect from and the manner as may be specified by board from time to time. So they've kept it open as to the manner and how the timelines, how it would be implemented, right? And maybe we'll get further circulars, further clarifications on its implementation going forward. So that aspect is yet to be clarified by SEBI. But you're right. We like it should come from them, because value chain would involve everyone in that value chain system. So it should have a threshold, because we can't expect all our value chain partners, the smaller ones especially, to be having substantial info around their BRSR core or ESG or GHG emissions or the criteria specified therein.
And as listed entities also, straight away going on with all our value chain partners in one go, may be impractical and not very easy to get it implemented source data from. And similar to cyber security incident, to ensure these particular compliance, there is far-reaching back-to-back effect. I see that BRSR core, the assurance part, and assurance by people who can be the assurer. So there were a mushroom of organizations which were coming up to make assurance about your BRSR credibilities. So right now they have said that only people who have expertise in that domain, and now we are still await as to what they exactly mean by expertise, or has it been left open for the industry to figure out if I get a certificate, for example, and I see this area as very, very exciting, and a separate work stream can be created out of this one in practice area as well as in consulting, as well as this impacting the making a great social impact like the CSR initiatives have done. So maybe this is such a vast subject that we cover it in a separate session, and a very interesting subject too.
Absolutely.
Vivek, in the one smaller line, it's for other listed entities, some volunteer disclosure. Now, do you think it's an indication for the other entities beyond thousand, top 1,000 that they should also start preparing? It is coming for them maybe in a couple of years, or do you? Hmm? Okay.
Absolutely. I think uh, this is the first year for many companies, FY 2023, FY23 reporting, which is happening in FY24. In the annual report, we have to give our BRSR reports. So for many companies, this is the first year of applicability, and the preparation started last year itself. There was a long lead time which was given to the corporates, to the listed entities to prepare for this, and rightly so, because this involves a lot of back-to-back work. And I think whatever the gradients the SEBI has prescribed for making this compulsorily applicable on various listed companies, they can rightly start taking baby steps in creating an entire ecosystem wherein such data can be identified. I would quote a couple of examples like use of renewable energy. So it cannot be created overnight, because there is a capex also involved into getting renewable energies. So planning from, if it is getting applicable for, say, in the next 2 years or 3 years, planning for it from today will make sense. Sourcing data about carbon emissions, how to reduce the carbon emissions, it will have a lot of back-to-back preparation that will be involved here. And creating, there is a new clause that has come up, which requires the companies to disclose about employment that they have generated in smaller cities, percentage of people.
Vivek, we're losing you in between.
Is it? So
Yeah.
I was just mentioning that companies are required to disclose about employment that they have generated in smaller cities, and the gender diversity that they have created right from the base level to the board of directors level. So and the pay parity also is required to be disclosed. All these initiatives require a lot of back-to-back preparation, and rightly so, they have been given time so that from today onwards steps can be taken, and gradually when the reporting time comes in next 1, 2, or 3 years, they are fully prepared to report these figures.
And maybe pardon my ignorance on this, but what do you think? I'm more of a, it could be more of a discussion also. What do you think is a broader intent of SEBI or the government, behind mandating these BRSR core?
I think it is now turned to corporates to take fair share of the social responsibility. CSR framework is already there. The ESG reporting which was earlier ESG reporting, now has been combined into a broader framework, which is now called BRSR, Business Responsibility and Sustainability Reporting. And to say it simply, to cut things short, corporates have to pitch in the larger social responsibility. We should not be dependent only on government initiatives, on sovereign initiatives, or initiatives from non-government or NGOs as we know them. But the capitalist company also should make their part and get involved into social development.
Absolutely, absolutely. And I would just like to add to that, as rightly pointed out by Vivek, government wants us as corporates to step up and contribute to the society, because it recognizes that we are taking from the society. As any corporate, any entity that is in India, then we are taking from the resources from the society itself. It's our responsibility to give it back. And I guess these mandating requirements are just guiding us to find out what we are doing, or encouraging us to do in case we are not doing, right? And as similar to what we talked about in cybersecurity, these aspects, be it ESG, be it social responsibility and all, it's very much developed in the Western world. And when the investor community looks at Indian entities, or talks to the management of Indian entities, they are very much want or keen on understanding what we do for ESG, what we do for our greenhouse emissions, how we are contributing back to the planet, back to the society. So I guess it's part of that larger discussion wherein our responsibilities we need to identify, or basically to sum up, how we give back to the society what we have taken, or how we give back more to the society than we have taken as an organization.
Absolutely agree. Yeah, Jyant, please.
Yeah, thank you.
Yeah.
So
I guess
I'd just like to add one point on the last thing. I have that feeling to say this.
Sure.
We all are concerned about our environment. We all are concerned about disparity in development in smaller cities and larger cities. There is a exodus of people from villages to the cities and cities to the metros. So we all talk about it, but how do we translate it into action? And as legislations are also always a reflection of what is going on in the society. So here is the reflection. Here is the companies need to disclose about their carbon emissions. We talk about environment. Here we have to take steps and display how we have what steps we are taking to protect the environment. We talk about disparity in development. We have to disclose and we have to contribute that this is what we are taking steps in. From
yeah. Thanks, Vivek. Ankita, if we can move to the next slide, please. Yeah, so this is more related to the agreements that have an impact on the listed entity, right? They have clearly captured the stakeholders who are related to the listed entity and who enter into various agreements, irrespective of whether listed entity is a party. So they have covered the shareholders, they've covered the promoter group. SEBI has covered related parties, directors, KMPs, employees of the listed entity, employees of the subsidiary holding or associate entities as well, right? So any agreement which is either inter se between these parties or with the listed entity or with third parties, which could have an impact on the management of the entity or the control of the listed entity, or impose a restriction or create a liability upon the listed entity. So the last two bullets would be applicable only in case it's not in the ordinary course of business. So the criteria that we need to look into is that agreement entered into by these parties specified, whether amongst themselves, with the listed entity or with any third party, impacting the management and control of the listed entity, then that needs a disclosure, or imposing any restriction or creation of liability on the listed entity in case this restriction or liability is not created as part of the ordinary course of business of the entity. Then we move to the next slide, which talks about the required disclosures. Ankita, if you can move to the next one. Yeah. So here it clearly says that if the listed entity is a party to such agreements and it is aware of the content, then that needs to be disclosed within 12 hours to the stock exchange with a simultaneous disclosure on the website and further disclosure in the annual report. In case listed entity is not a party, the onus is on the stakeholders. Stakeholders to inform the listed entity as to the content or the key parameters of the agreement that they have entered into, which is creating or impacting the listed entity, as we talked about in the previous slide. Then listed entity has to further disclose to the stock exchanges within 24 hours of receipt of that intimation, right? And then the further disclosure on the website or in the annual report is covered. Now, we might have a couple of questions here as to when would we consider such or what would be such kind of agreements, right? So, Vivek, if you can throw some light around the kind of agreements that we are talking about here, that'd be great.
Sure. So it is very interesting to note here that the law uses the word purpose and effect, and this has been used in other regulations also recently by SEBI. So I think the purpose number one to using this is that the people who are privy, people who are parties to such contract, they are in the best position to judge where the agreements have the purpose and effect of making any impact on the management or control of the company. So to a large extent, it is self-governance that gets reflected over here. Second point is there are also uh, interpretations being taken in the industry that purpose is one part and effect is one part, and both has to be fulfilled, and then only this disclosure requirement arises. I'll quote by way of an example. Suppose the two shareholders of company get into an arrangement between themselves that they will facilitate appointment of a director nominated by one of the parties, and maybe some other obligation on the other party. So while this is between the shareholders, the company is not a party. Let's presume. In this context, the purpose is that one will facilitate, and the effect will be seen only when such director gets appointed. So while the purpose they can retain between themselves, me and you, Thomas, if we can agree about such thing for a large listed company, maybe we will not be able to give an effect to it. Though our purpose of our agreement is such, but maybe we are not capable, or our shareholding of is such nature that we may not be able to get this effectuated. In that case, I don't think this is a disclosure that is needed by the people who are in this agreement to the listed company, which will further onwards disclose to the stock exchanges. Suppose we take the same example and we involve company is also a party. So here in company is fully aware of the background and facts. If the effect to that particular purpose for appointment of a nominee director, for example, let's say, is there, then purpose and effect both are getting fulfilled. There is a disclosure requirement. Suppose there is an effect, there is shareholders agreement, there are marquee investors, they have entered into an agreement with the listed company, with the founders, with the promoters, whatever we say them. Sometimes founders, I am saying for those people who have founded the company, who were earlier promoters, but because of dilution and all, their shareholding have come beyond a particular threshold, and they are no longer promoter, they are only a founder. So whether a third party investor shareholder has an agreement with the company and the founder or promoter, and the purpose is to manage the control of the company, uh, and without having an express provision in the agreement, they agree for one particular person to be the managing director or CEO or the operations officer or the chief finance officer or the compliance officer. So in such circumstances, we'll have to see that both has to be there. Only effect will not be sufficed, will not require a disclosure. The purpose also should be reflected in the document, and the effect also should be reflected actually on the ground. Both needs to be seen, and then a disclosure needs to be made.
Absolutely. I guess also I just want to I just want to add that when we read the provision, it reads as the parties are directly or indirectly creating that you can say the impact on the listed entity, right? So it could also be an indirect impact on the listed entity. It need not be a direct impact.
Correct. By including the indirect word, I think it has been it has tried to plug any loophole, and the amount of self-governance has increased tremendously here.
Yeah, absolutely.
And Vivek, where does the onus lie if in case of a third party, if, if the
See,
company is,
please complete yourself.
yeah. So I'm saying is if in case of a third party is is entering into a agreement, and the company and they are not they have not disclosed the company. So where the onus lies, that with the company or with the with the third party.
If company is a party, then onus is already on the company because it is
Right.
fully aware of what is in the document and what effect it has taken. If the company is not a party, it's on the third party who have between themselves got into an arrangement. They are supposed to make a disclosure to the company, and the company onwards has to make that disclosure to the stock exchange, display on the website, and mention in the annual report also.
Okay.
Correct. Absolutely agreed. Absolutely agreed with the thoughts shared by Vivek. And one more point to add here is that these timelines are for the disclosures which for agreements that would happen post these provisions come into effect, that is 15th of July onwards, right? But the question is what happens to the pre-existing agreements that we have? So the pre-existing agreements also need to be disclosed within the same timelines as per the provisions which have been notified. So if we have a pre-existing agreement which falls under these criteria, that also needs to be disclosed in the same manner one time, and then going forward whenever in future we enter into some similar agreements.
Okay.
Yeah, I guess I would request Vivek to take these slides going forward, and thank you for the patient hearing.
Just a quick time check. I think this discussion is going is becoming very interesting, and Vivek and Thomas, the kind of examples you have, I think it is enlightening all of us. I would request all the viewers to just put a thumbs up if you're okay for us to extend the time by that 15-20 minutes, so that we don't have a bonding on the time. Yeah, Vivek, Trishul will take a note on on everyone's consent, so you can please continue.
I can already see some thumbs ups coming up. So thank you everybody for your patient hearing and giving us time. So I quickly jump on to Regulation 37A of SEBI LODR, and on a plain reading, it says that if a listed entity gets into sale or disposal of whole or substantially the whole of an undertaking, then it has to take a shareholders approval by way of a special resolution. So to elaborate a little more on this one, so firstly, this particular provisions talks about all arrangements outside of the scheme of arrangement. That means we refer to the schedule part 15 of Companies Act, wherein mergers, amalgamations, arrangement with creditors and members is prescribed. So part 15, apart from anything that is contained in part 15 of the Companies Act, and also in the insolvency and bankruptcy provision, wherein NCLT's approval and shareholder special resolution approval is already prescribed for. Other arrangement, this is somewhat parallel to, I think, section 180 of the Companies Act, which allows board of directors to take certain decisions, but only with the consent of the shareholders. So these provisions being little parallel to section 180, so we can very easily rely on the definition of undertaking, substantially the whole of the undertaking. These particular reliance we can place on Companies Act. So undertaking, as it is defined in Companies Act, any particular project or particular setup of the company wherein the investment is 20% of its net worth, or wherein the contribution to the total income by that particular factory, office, service, a branch, or a warehouse, whatever it may be, is more than 20% of the total income, then it will be treated as an undertaking. And substantially, the whole of the undertaking literally means for that 20% of that undertaking. So if any such incident happening, an undertaking 20% of the net worth or total income of the company, and further 20% will involve the whole or substantially the whole of the undertaking. If company in any form is alienating with such an asset, then prior approval of shareholders by special resolution is required. And as a precursor to the special resolution, there has to be a notice which has to be sent out for the general meeting to the shareholders. The explanatory statement has to very clearly specify the object and the business rationale, commercial rationale of such a sale or disposal. Okay. Maybe the company will have to indicate that the capex, that the because company do it's a destruction is the genesis of creation. So older setups are sometimes disposed of to create better and more better setups, or maybe company is in the process of change of line of business. So in all such cases, the business rationale has to be displayed to the shareholders. Use of proceeds has to be clearly mentioned out. Now, though it has to be mentioned out in the explanatory statement, shareholders get satisfied, they approve the resolution, and the company goes ahead with the sale or disposal of the undertaking. Now, when it comes to who will monitor the sale of proceeds of such thing, there is no express provision, but as a good governance, we can rely upon any monitoring agency. Company can appoint a monitoring agency as a good governance measure. Company can internally also do the monitoring and periodically disclose to the stock exchanges, to all the shareholders. And how do we disclose this? The mechanism that is being used for disclosure of fund utilization for IPO or any other fundraising initiatives. Similar under corporate disclosures, we can make this. If not quarterly or half yearly, company will have to give this out in their annual report about how has the use of proceeds been done, whether it was in accordance with what was approved by the shareholders earlier, or were there any deviation. Now, if there is proposed any deviation, how do the companies go about it? I think since the use of proceeds was approved by way of special resolution, any deviation from such use should also be approved by the shareholders through a special resolution also. So this is my take on this one. Thomas, any thoughts from your side?
No, I guess, Vivek, you've well covered every aspect that you've rightly mentioned, how we need to disclose along with, in case of any deviation, what steps we need to take. Just to add to the disclosure part, the quarterly disclosure that you mentioned obviously is not flowing from the law. So it would be a best practice to follow by companies, though not mandated. I guess the minimum disclosure that like we would suggest as professionals is what we do in the annual report, that okay, we did this disposal of undertaking and the utilization was done in a particular manner. So once in one annual disclosure is mandatory, I would say, as a basic governance part, and best practice would be a quarterly disclosure, as mentioned by Vivek.
Agree with you.
Vivek, there is one proviso in this regulation, that is approval from majority of the eligible public shareholder is required. So if you can throw some light on this.
So this can be there can be shareholders who are related to this particular transaction, and apart from means in nutshell, the non-interested shareholders, their approval is also mandatory. I think that their number has been prescribed. I think 50% of the non-interested shareholders, and overall a special resolution.
Okay.
Yeah, so here comes one of the most interesting part in this particular entire framework of SEBI second amendments, SEBI LODR second amendment regulations. And herein, we see Schedule 3 as our cornerstone, a touchstone of disclosures that the companies, listed companies, are required to make to stock exchanges, to their shareholders through the stock exchanges. And Part A of Schedule 3 has 2 paragraphs, rather 4 paragraphs, paragraph A, B, C, and D. So paragraph A is which is deemed material, wherein company has no discretion to apply. They are mandated to make those disclosures. The clarification that has come circular by way of circular dated 13th of July very clearly lays down as to if any of these incident happen, what are the timeline for disclosure. If it is happening in a board meeting, if the final decision is happening at a board meeting, it has to be disclosed within 30 minutes of the board conclusion of the board meeting. So there was an era wherein there was outcome of board meeting, which is again prescribed, I think, in point number 4 of para A, which talks about certain matters which has to be given as outcome within 30 minutes. Along with that, we have to be very mindful as a compliance officer. any decision that is happening in the board meeting, we have to meticulously scan it through and be prepared that if any of these is falling under para A, like mergers, amalgamations, there is a long list of matters, and we have to make disclosure within 30 minutes. Second aspect is para B, wherein the materiality threshold has to be looked at. There is a materiality threshold that has been prescribed. There is a guidance on how we should calculate it. We will look at it in the second paragraph. Suppose, for example, our threshold for a particular listed entity is 100 CR. So on all those points, to quote a few, is like expansion of facility, opening of a new place of work, whether it is an office or a factory or a warehouse, or closing of such places, has to be tested on the materiality threshold of 100 CR. If value is exceeding 100 CR, the value of event or information is exceeding 100 CR, for example, it has to be a material and there has to be a disclosure. Now, an interesting question is, how do we calculate the value of an event or information? So taking this particular example of office or a warehouse or a factory, the capex can be one aspect. The revenue proposed to be generated from that particular facility can be another aspect. Depending upon such case-to-case basis, it is a total discretion on the management of the company to evaluate what can be a materiality aspect for that particular event. So one example was opening of offices. Another example is bagging or termination of contract. Interestingly, the words used over there is not in ordinary course of business. So I still wonder what can be a contract or termination, bagging or termination of a contract not in the ordinary course of business. I'm sure there are pretty large bunch of examples within the industry, but again, an intriguing question for all of us. And again, there are several other pointers in paragraph B where we have to test the materiality. If it is exceeding the threshold, say 100 CR, then there has to be disclosure. Timeline for disclosure, as I mentioned earlier, 30 minutes if that is getting decided at a board meeting, 12 hours if it is, keeping the board meeting aside, if the information is emanating out of any other source from within the company, then the disclosure has to be within 12 hours. If it is emanating from outside the company, so 24 hours of that particular information getting to be known by the company. So these are the timelines that has been prescribed. On the upfront, in addition to timeline, now the disclosure also has to be, there has to be a minimum set of information that has to be disclosed. Again, guidance on criteria for determining material, I think Annexure A gives the details that needs to be provided in disclosing the events. I'll take example of, say, mergers and amalgamation. The target company, the business of the target company, the business rationale of taking over, acquiring stake in the target company. All these details are target completion date. All these details are the minimum information that that SEBI mandates a listed company to disclose to the shareholders through stock exchanges. Timeline wise, as I was about to speak a couple of minutes back, this regulation looks very simple and straightforward. However, managing this back to back is a big task. There has to be an entire ecosystem that has to be created within the listed organization. There has to be a high level of awareness that needs to be created with the functional heads, with the top leadership team, with the people, movers and shakers within the company, with the people who have information within the company, that such information flows in a structured and a systematic manner to the compliance officer, and compliance officer is in a best place to make such disclosure to the stock exchanges from time to time, as in these events happen. Because moment such incident happen, the timeline for making it to the stock exchange is very, very short. Now, how do we justify? Suppose I make a disclosure now. How do we justify that I have done it within 12 hours or last 24 hours? I think there has to be electronic trail or a trail of formal or informal communication or a trail of physical documents that as a compliance officer you must create for our record, because regulator can any day come over and have an inspection of our compliance framework, and that would be very handy at such points of time. So we'll have to display that these particular things are done within time. Like the outcome of board meetings, when we give out, we clearly indicate that this was the conclusion of the meeting. This was the time of conclusion of the meeting, and herein within 30 minutes, I am displaying this to the stock exchanges, to my shareholders. I think no specific format of disclosure has been provided, except that Annexure A, wherein minimum information set is given. So I am not sure, and I don't think it is practical also. In my personal view, I don't think in the disclosure it is required to be justified. That's my personal view. Feel anybody having any different opinion, feel free to put it up on the chat box. And my personal opinion is that we do not need to justify that particular incident happening within 12 hours or 24 hours in our disclosure to the stock exchange. Anything from your side, Thomas, on this one?
Vivek, you've covered it great. Like you've covered all the aspects required here. Definitely, it's not going to be easy job being a compliance officer with these amendments that have come up, especially if you look at the Schedule 3, because your dependencies on your peers, the other members of the senior management team, has increased a lot, because there would be a lot of activities which you are not directly part of or which you become aware of at a later stage. Now, those activities have become relevant for you to be known, I would say, within at least 6 hours of the happening of the event, to ensure that you are able to report within 12 hours, because you would also require some amount of time to draft the response, to maybe discuss it with the other members of the senior team before, or the management at least, before you send it out, right? So because the right communication needs to be made in such instances. It could be a negative instance, it could be a positive instance, but if that event has occurred, the responsibility of disclosure is with the compliance officer or the company secretary of the company. So the person who is supposed to provide that information, he may be a part of the senior management team, but he or she is not the one person responsible. We as company secretaries or compliance officers are. So our dependencies have definitely increased. We need to ensure that channel is built within our organizations and we are aware of such information. And also we have a system or a process laid out wherein we are able to meet this timeline. Not an easy task, I would say. Larger the organization, the more challenging it would be. Right.
Absolutely.
And yeah, and I guess touching upon the timeline aspect, which you mentioned, that mentioning timing as we do in our board disclosure, I would just like to add an additional point here. If we are able to mention the date or time, we can say that would be a best compliance. And we are actually able to make the disclosures within the timeline, but we would be setting a precedence for our future disclosures.
Absolutely.
So if today I feel I am say I became aware of an incident within 6 hours and I'm disclosing within 10 hours, I would want to showcase that, and I would say, okay, I'll mention the hour. But tomorrow, in case you are missing out on that, or if you are not sure about the timing of the happening of the event, then that could be your undoing and it would come back to bite you later. So I guess I would go by what you suggested, that we should follow a good practice here, not a best practice, if we are unable to continue that best practice. Because
and initially, totally agree, Thomas. And initially, the level of awareness about this particular requirement within any organization will take time to seep in. Culturally, there has to be a shift. And this particular provision puts company secretaries and compliance officers right at that pedestal, wherein many companies have management dashboards, wherein all the latest updates, the plans, the future plans are being put up on the dashboard. There is a discussion happening, say every day, or say every Monday, or once in every fortnight, depending upon how the companies are structured. So it's very essential for compliance officers to be a part of such dashboards and discussions, so that we can rightly and timely identify about the disclosure requirements, pitch in with our expertise over there as to what particular things we should look at, the management should look at, and what particular things require disclosure. And requiring disclosure means to say this particular information will become public. So advising right upfront at the stage of being such things being conceptualized, being discussed at initial stages, mm, the people in the helm will also be able to make an informed call about how to structure, how to take steps towards those particular incidents or events. And that annexure 3 also becomes very important in terms of the guidance on when an event or information can be used to have occurred. So very interestingly, this particular annexure talks about two aspects. One, information which is emanating from the company, and one, events like they have quoted examples of natural calamities and all. So both these aspects has to be very carefully looked at for any compliance officer. Obviously, national calamity, as we were discussing earlier also, uh, I might be aware of a adverse incident due to natural calamity that has happened in one particular facility of, say, a company which has presence across India. So at that moment of time, though people may be aware or educated about the compliance requirement, disclosure requirements, they would be more, their priority, or everybody's priority would be to do the firefighting first and then look at the compliance. So, and which is sometimes can be very justified also, very rational also. So at such incident, I think the disclosures has to be anyways to be there in the public domain, and we can mention as if there is any uh, delay that has happened, or there is any judgment that has been applied that yes, this was material, we can quote that particular judgment also, that we finally arrived at this being material, we are reporting it to the stock exchange, though the incident happened a couple of days back, but this is when we arrived after firefighting, after doing the priority stuff, we are reporting here into the stock exchanges.
Vivek and Thomas, one of my questions to both of you. See, uh, if I look at this LODR requirement, they try to become more and more transparency and make it very public. But the way I think the business leader thinks and the business leader, he works, they are always secretive till the time things have really happened, and it has they have kind of created a competitive edge for themselves in the market. Now, how do you go and create this culture shift within the organization and and a business leader, that some of they have to at least keep you informed about these things. One, you or definitely talked about the management dashboard, but as a culture shift also, wherein at least they start looking at whether it will fall under the disclosure requirement, or they'll start keeping you informed about these discussions as well. Because sometimes the judgment, because the hours are the timelines is very small, and in the large organization, sometimes 12 hours, even 12 days also sometimes is too less of a time to even conclude or agree on some basic aspects as well.
Absolutely.
Absolutely.
Yeah. Yeah,
Yeah,
Vivek, go
go
on.
on, Thomas, please.
All right. So as Vivek had mentioned in his address earlier, that there is a requirement of a cultural shift within organization, and that would happen gradually. So our onus on us as company secretaries and compliance officers would be to make them aware of the importance of informing the compliance team about such events, or informing such events to the stakeholders in general. The concern, Jen, that you rightly raised is that the management is generally very secretive till those say initiatives, events, or information becomes concrete, at least, because they never want to disclose something which they are not even sure of would get completed. So I guess Vivek can elaborate on that with examples, but I'll just
Sure.
conclude that the management's thought needs to be built up in such a manner wherein we are able to enlighten the management that this is a minimum disclosure that we would be required to do because it's a compliance requirement. At the same time, we need to be mindful of not disclosing such information which is not meeting the threshold or internal threshold that we have created or the materiality criteria that we have created, and which could have an impact or an adverse impact on our business decision in future. Right.
Absolutely.
So, Vivek, if you can elaborate with that.
Yes. So, Jyant, you had a very pertinent question and very relevant one also. I'll try to illustrate this with an example. Suppose a FMCG company is putting up a factory or a plant at a specific location, which they foresee can be a great market in near future. So upfront, they may not, while SEBI LODR has, it appears to be that it has given some very stringent guidelines to all of us and some very stringent disclosure requirements, but it also has built in some kind of flexibility also. Why I say that is, if I'm building that plant as a listed company, though the capex may increase that threshold amount that I have calculated for my company, but it is not a very stringent criteria that SEBI prescribes. Maybe I not go by the capex requirement criteria. I'll get my plant completed, the construction, I'll let the construction happen and get it completed. There can be a piloting in the plant. There can be maybe plant, warehouse, or whatever that facility is. After the piloting, when I'm reasonably sure, or when I'm started, when I have started clocking a contribution from that particular facility, which is exceeding my threshold criteria, at that point of time, I'm reasonably sure that yes, I'm going ahead with this particular project, and there is where I can take a materiality decision. This is now material, and I must disclose it to the stock exchanges. So this is my, because sometimes what happens is, while I can have a plan of opening a facility in a say Northeast or say Central India or somewhere, that may not work out. Even after having a huge capex or materiality capex, that facility may not be successful.
Right.
We can try piloting it, but there can be manpower issues. There can be many other local regulatory or local issues, environmental issues. There can be so many things that can come up over there. So, and many companies also do not wish to alert their competitors for that matter. FMCG
Right.
is a very crowded space. People are very competitive over there. So it is totally a management call. While that does not means that there is a workaround for the compliance, workaround for the disclosures. I think SEBI's intent is very clear that good or bad, whatever happens with the company, let the shareholders, let the stakeholders be aware. But yes, there is a flexibility on the management also as to when to time their disclosures.
Okay.
Absolutely. I guess I would just like to sum up as what Vivek shared. So if management is of the thought that we should be disclosing every material event or every event which would have a material impact in future, then it can disclose basis the projections, or once it actually achieves those projections which have been anticipated. It works both ways. In case you are doing it on projections and it doesn't happen, then there is no stoppage under the laws that we go ahead and disclose that it was proposed to be implemented in this manner. We had disclosed it earlier that it would add so much to the capex, or there would be so much addition to the top line or our profits. But now this is not happening. We can always do that if we want to follow the best practice, or we can do such disclosures once we are aware that addition is actually going to happen. So it falls down to the management philosophy and the compliance practice that we want to follow in the company.
Thank you so much. Yeah, thank you. I think quite interesting.
So we can move on to the next slide. Let's quickly look at the materiality threshold that has been prescribed by the regulation, Second Amendment regulations. It is getting covered under Regulation 30, Clause 4, Subclause C. The first threshold is 2% of the net worth, 2% of the turnover, 2% of the net worth. calculated basis the last audited consolidated financial statements of the company. And the third criteria interesting to know is 5% of the average last 3 years PAT of the consolidated financial statements. Now, PAT can be negative. So SEBI has very clearly come out with an example saying that if the last 3 years PAT, for example, is -20, -30, and -60, say for example, then we'll have to pick up absolute figures 20, 30, and 60. Sum it up, divide by 3, and that's our materiality. That's our third criteria of testing the materiality threshold. So it can be -20, -30, -50, or for example, the interesting aspect to note here is, suppose in a growth stage company, the turnover can be high, the net worth can be high, but it is reinvesting its cash churn, reinvesting its capital into growth, right? Therein the PAT can be always negative. That does not mean that the company is not doing well. It may be operationally it may be cash positive, but since it is reinvesting, the capex is higher. So at the end of the day, PAT may not be reflecting the performance of the company. So in such companies, suppose from a loss era, it is moving towards the break-even era, and then from the break-even era, it is picking up to the profitability. In this transition period, from loss to break-even, the materiality threshold will drastically drop. It may come somewhere around 0 or so, and then it will gradually pick up when the profitability increase, because we are calculating the absolute numbers over here. So herein, I think there is amount of discomfort that has created within the industry, if I may say in so many words, wherein such companies are apprehensive that gradually they are performing better, but that materiality threshold will come down. And since it is least of the three, obviously the 5% of average PAT will be the least figure, which will become the touchstone. And in that case, how do we make the disclosures? For example, if I'm expanding capacity, para B of Schedule 3 talks about capacity expansion. I am opening a kind of one last mile store, whether it is any industry, whether it is FMCG, whether it is a medical setup, or whether it is a hospital, or whether it is a logistics company, or any other industry. If it is setting up a large last mile facilitation center, then the capex, if capex is one criteria, it is going to be above the threshold. And how do we comply this? Little difficult for the company to come to the fact, to apprehend this as to how to go ahead with this one. Any thoughts from your side, Thomas, on this?
Yeah, absolutely. You've rightly pointed out that definitely for a company which is going through that transition phase wherein it is reducing its losses and going back to profits, there would be a challenge of a lower materiality threshold there, because we have to choose the lowest of the three. That definitely comes up as a challenge, and like many companies who are in that phase would end up disclosing many more events than say completely loss-making companies or who are in the profit zone. If you are either on either sides, then it's fairly fine, I would say. And if you have larger numbers, but if we are going through the transition, as you rightly said, it can be coming close to even zero. And that could be a big challenge for the corporates who need to comply. But I would say still the regulators have tried to offset it by making it absolute figures, right? Rather than going by the actual loss or profit figure and dividing it by the 3-year average, or making it a 3-year average, because that would have pushed it further down, in my understanding. Because if it's say -100, 0, and +100, the answer would be simply 0. While because we are taking absolute numbers, it is 200 by 3 and not 0. Right. So yeah, they've somewhere tried to offset that impact here, but still it pushes down the materiality threshold by a lot. Maybe I'm not sure whether if industry is facing challenges and we can voice concerns, maybe they can increase that 5% and move it higher, that could give some solace to the corporates.
Or maybe a average of larger period. So average does helps, but nevertheless, transition is going to be a challenge in terms of disclosure requirements. Every small incident you'll have to disclose, and the disclosure itself, sometimes smaller incident does not make sense to disclose, and it is not also the objective of the regulator that you keep coming up announcing every other store that you open.
Correct. Absolutely. Agree.
Right.
So we can go to the next slide, I think, being mindful of the time. And I quickly touch upon the timeline for disclosure, though we talked about in the previous slide also. Like if the board is taking a decision within 30 minutes, we have to disclose to the stock exchanges. If the occurrence is of event or information is within the company, 12 hours. If from outside the company, then 24 hours. So as we talked about this in a couple of minutes back also, that though this appears very straightforward and simple on the face of it, we'll have to build a back-to-back entire ecosystem so that relevant information flows up. The minimum information required that is there in the annexures is available, and the timing is right for maker to make the disclosures. So that's from my side.
So just to clearly summarize it, Vivek. So when you say 12 hours, 24 hours, this is going by the clock. Any incidents happen 6 in the evening, so you have 12 hours to report. Is that what I mean here?
Yes, absolutely. This is by the clock. There is no concept of working hours here. There is no concept of forget about days, because days hasn't been mentioned over there. So even if some incident happens on a Sunday morning, the compliance officer has to be on the toes and be ready to report it within 12 hours, that is Sunday evening, to the stock exchanges. There is no concept of holiday here. There is no concept of any scope of a larger time frame required for reporting. So this puts a compliance officer position in a great spot in terms of being always available. So there has to be a robust team that should be taking care of this particular aspect, because sometimes what happens is it is not only a disclosure in a paper form that goes to the stock exchanges. There has to be a parallel press release. Many companies go for press briefings also, and there has to be, it has to be uploaded on the website also. So back to back, your communications team, whosoever takes care of the website, whether it's the company secretary himself or any other team is there to take care of that particular update. Everybody has to be closely knit and working by the clock in a clockwise precision so that this can be achieved.
So which means you can't take a direct flight to US. You have to stop by to check it.
Yes. So I have to have a backup team to do that.
Thank you. Okay.
So one particular interesting aspect has come about the disclosure that news that gets published about the listed companies in various media. So herein, any registered or permitted or regulated media, either permitted by any regulatory authority in India or a foreign media also. The touchstone is that it should be registered, permitted, and regulated, whether in India or outside of India. So it can be any current or news affairs, any newspaper, any news channel. So any report about the company getting published over here has to be clarified, affirmed by the company, by the listed company. And again, the timeline for doing this is stringent. Before we go on to the timeline slide, which is the next one, we have to be very clear that this will exclude all social media. There can be any speculations that can happen in the social media which company is not bound by to give a reply on. And however, if the company itself is making an announcement on a social media platform which is material, so such material event should first be reported to the stock exchange and then be posted on the social media. So again, compliance officer has to take a very pragmatic approach over here, work back to back with people within the organization who are responsible for doing this. If the company secretary himself is doing that, then that's another thing altogether. But most of the companies, there are specialized people who are taking care of these affairs. So practically, how do we do it? See, one simpliciter that I look is that we set up Google alerts or Bing alerts or any other alerts within our system. And that particular alert, we may be the person who is at the execution level can get that alert every couple of hours or maybe every 12 hours at the most. So that any news that has come up, the company is the first one to be aware of. Suppose the company is going ahead with a proposed merger, and that gets reported in the newspapers. So, quoting my example, if 9:32 a.m. is when it is getting published on a digital media, then the clock starts ticking from 9:32 a.m. itself. There has to be affirmation, a denial, a clarity, whatever the listed company thinks appropriate, that has to be gone out first to the stock exchanges, and then a press release can also be done. So we can go to the next slide.
So Vivek, one small question here. So you said you put the Google alerts, because I found that as a very effective hack if we properly use it. So what is your recommendation to everyone that what should be the keywords what you put, because that becomes very important. Is it the company name or some other things which has worked for you?
Yeah, company name is the first thing. I think we should be generic in our search alerts. For example, we can quote the first name of the company. We can leave aside for example, XYZ Technology Private Limited, Technology Limited. We can leave aside the first name, the popular brand names of the company, because FMCG companies tend to work under different brand names. So all particular brand names, plus your KMPs and executive directors, as well as I think the independent directors name also. We should set an alert for all these particular keywords, and any other permutation and combination. I think the compliance officers or the communications team or the media team within the company will have to explore a couple of permutations and combinations, and we should target to broad base our search, and then on all those searches we should set an alert. And every couple of hours, whatever gets published, there are national, international newses, everything is covered. Everything we'll have to, because there are specific industry wise pages that is globally popular, that may be getting emanated somewhere in the US or say Europe, but they are very popular in India. So all those media also we have to keep a keen watch on, and then be prepared with necessary backup clarifications or denial on all of them. So thankfully, this particular thing is getting the effective date of this particular amendment is 15th of July, but the regulation says that we have to be compliant with it from, can you, Ankita, move on to the next slide? See, for the top 100 listed company, as per market cap, it has to be from 1st of October 2023. And for the top 250 companies, it has to be from 1st of April 2024. For rest of the listed companies, there is no prescription as of now. But this is a very good timeline that that the regulator has given to all the listed companies. Because again, in able to be compliant, to be on the positive side of this one, we have to be very well prepared. There has to be a back-to-back ecosystem to source such data, to find necessary clarifications within the organization, and then giving out, channelizing those clarifications to the public in a most appropriate manner. Right? Sometimes, M&A news are ones which get, I don't know how, leaked out to newspapers and media houses before it is even internally widespread within the company. And giving a positive color to it, or giving a right color to it, because what may come in the media is a color that they see from their third eye, from their own perspective. That may not be wrong, but we have to give it a right perspective with the right color and give it out to the shareholders. So, and for rest of the companies, I think for all the companies, I think from day one, from today itself, we can start having such kind of ecosystem built up. We can start complying from today. so that gradually when the time comes 1st of October or 1st of April 24, we are fully prepared for it. And for the other companies also, all other listed companies also, there has to be they should be voluntarily started to do this, because it is in the best interest of the company itself and shareholders themselves.
Correct. Just I would like to add one concern, major concern, which I see, though, as Vivek rightly suggested, a few options wherein we can know about the reporting in the mainstream media, especially when it is through an electronic mode, right? Be it news channels, something out in news channels, or even in the electronic e-papers or e-forums. The concern would come when something is getting published in a newspaper which is registered anywhere in the world, but may not be getting captured in the e-form, right? But you are bound to comply within 24 hours of reporting of the event, not being aware of the event. That's a big concern or challenge. So suppose there is a smaller registered newspaper in China or any other country for that matter, or even within India, which may not, that information may not be getting captured in Google or other search engines or online platforms. It would be very difficult for a compliance officer or for a company to be aware of such an information. So that's a big challenge, but I guess the larger idea is to cover the major events which generally gets reported in the mainstream newspapers and not in the smaller ones. So I'm sure there could be gaps around the compliance because of inherent difficulties in knowing that information. But the idea is to cover the major events which generally gets reported in the mainstream media itself.
Right.
Absolutely. So there is a small area in today's highly digitalized and IT savvy world but there still exists a small area of such physical mediums which is not within India, or in fact, if it is within India also, that is difficult to track.
Correct. Absolutely.
And if it is overseas, most probably if something getting published about the company overseas, the company must be having some kind of presence or facility or opening in that particular country. And the awareness should not be restricted to the team, whether in India or elsewhere, who is working on it, but it has to be a global awareness that a compliance officer has to create across the organization.
Correct.
And we make one small point. Sometimes what happens, the rumor just don't die down with one clarification. So, it may come in some other form from some other source of some other news channels or media house. So do you clarify every time, or your one clarification is good enough?
I think one clarification from the company is good enough. So you inform to the exchanges, you put it up on your own website. You also give out a press release. And if the matter is significant enough, there are sometimes press conferences, press briefings also directly done in person, so that it has a wider coverage. I think depending upon the impact, depending upon the size of the news, company will have to keep a flexible and very pragmatic approach on this one.
All right. Thank you. All right. Thank you so much. I think this brings us to the end of the discussions. Maybe I request Mike to quickly summarize it, and we can conclude.
Thank you, Vivek and Thomas, for covering all the slides very beautifully. I think our audience will be benefited from your discussions and your practical view on those regulations. So I'll not take much time because we are already running out of time. So what are the to do for the listed entities? In my point of view, many enablers are required to keep compliant with these regulations. Need to strengthen the various teams, including compliance, finance, EHS from BRSR perspective, and even other teams, senior management as well, and make them aware about these changes and amendments, so that the right action should be initiated and information should be disclosed within the timely manner. Listed entities along with the other teams need to strengthen their IR and PR team They need to devise with proper systems and controls where they can track the rumors or any information from the mainstream media. I think not every rumor has to be reported, but which is not general in nature and relating to any material event of the entity is required to be reported. Listed entity need to figure out their existing directors, which falls under such criteria. They have to take such approvals and they need to plan accordingly. Uh, uh, Analyzing each and every transaction and events on the basis of the thresholds, compliance team and finance team should be aligned, should be sync with each other, so that before such transactions and where they have to take any approval or if there is any disclosure requirement, then they should act upon accordingly as per the regulations, right? So I think compliance team and finance team always sits very nearby, but now after these amendments they have to be very much in sync, so that the required disclosure and the action should be taken within the timely manner. For complying with these amendments, I think entities need to amend their existing materiality policy immediately, so to comply with these amendments and the LODR requirements. So, and obviously with respect to the agreements, listed entities, while executing any of the agreements whose purpose and effect is impacting the management or imposing any restrictions, I think they need to figure out before executing or planning or during the planning stage also. Even any clause of the agreement may have such purpose and effect. So I think not every entity has to analyze the whole agreement or not even the clause that may have that purpose and effect on the management of the listed entities. So I think by this, thank you so much. Now we can take the questions which are not addressed during our discussions. So
Yeah,
I think
I can see some very interesting questions that have come up on the Q&A and on the chat. Please go
yes.
ahead, Mike.
So okay, there are a couple of questions. One of the question is, how do these disclosure requirements compare with the regulations applicable to listed entities in overseas capital markets? So one of the speaker has asked this question.
Can you come back again on that one, Mike? Missed it.
How do these disclosure requirements compare with regulations applicable to listed entities in overseas capital market?
Okay, so does that mean that SEBI as a regulator, how stringent or flexible it is as compared to overseas regulator? Is that so?
Yes.
So it depends upon capital market to the limited extent of my exposure to the overseas market. I can say that some are very lenient, while others follow a self-governance approach, and there are some which are very stringent. So all models exist within the market. So matured market, we see a lot of self-governance. People are very open upfront to bring up the disclosures. US market is one. SEC promotes a lot of self-governance initiatives. I have witnessed a company wherein a particular instrument was listed on NYSE, and there were some very fast-paced decisions that the company internally wanted to make in order to be more relevant in the overall framework of the existing IT world. So it got unlisted itself, quickly went through all the decisions, because the listing process requires timelines, disclosures that may not be very very easy to implement. And after completing and after finding a footing which was more market relevant and made its financial strength more robust, they got listed back again.
Okay, quite interesting.
Yeah, so all sorts of model are there. Singapore Exchange, to my limited understanding, that they are very liberal about the market disclosures.
Correct.
Thanks, Vivek.
Yeah. Just to add, Mank, like there is no straightforward answers because that overseas market would fall upon various regions across the globe. So it depends on which market we are talking about and comparing those regulations with us, right? But to a larger extent, we, as rightly pointed out by Vivek, there are mature markets wherein self-governance is more promoted, right? But we are still in a stage wherein the governance is in a push form, wherein we are asked to comply with these requirements so that necessary disclosures are being made by the companies. So it depends on which the location or the market that we are talking about, also in the stage of development that market is, that the compliance would vary accordingly.
Yeah, thanks, Thomas and Vivek. Next question is whether any case filed on a company or by a company in a day-to-day course should be considered as an event for this, or an order from competent court should be. So,
Yeah.
Vivek or Thomas, yes.
I think Part B of Schedule 3, Part A, Para B does cover litigations. At the inception stage of the litigation itself, if the value of claim or the potential impact on the company, whether it's a defendant or it's a plaintiff in either of the case, if it is determined, it can be determined, and if that exceeds the threshold limit, yes, we have to disclose it upfront. We do not have to wait until the order or judgment to come up.
Correct.
Your
So
thoughts,
based,
Thomas, on this one?
yeah. So basis, as rightly pointed out, it would be based on the materiality threshold that is applicable to the entity. Accordingly, we'll inform or not inform, not just because there is a case filed against or by the company that we need to inform.
And there is no concept of normal course or not in normal course in case of disputes and litigations.
Correct.
Okay. Thanks, Vivek and Thomas. So I think we have covered most of the questions. Ankita, do we have another questions? I think we have covered most of the questions during the discussions and after our deck.
No, I think, in the interest of time also, I think we should conclude it now. We just realized it's almost 2 hours.
2 hours, yeah.
Yes, and thank you so much, everyone, for your patient hearing. And I was definitely anticipating that we would overshoot the time by 15-20 minutes. But thank you so much, Thomas and Vivek, for such an interesting discussion. And going so much of depth, and I just mentioned at the beginning, this all shows your passion towards the subject and your deeper understanding that has kept all of us intrigued into the discussion. People have all stayed back and we've still been listening. Thank you so much once again. I am sure this is very valuable for all of us, and everyone, we will be also posting a recording of this session on our YouTube channel. You could go and watch them again. I'm sure you will. There are a lot of discussions which have happened where you may have to go back and refer to those pointers once again, and that will be quite helpful for sure for you. Thank you, Vivek. Thank you, Thomas.
Thank
you. It was entirely a pleasure
Thomas,
to interact with you, Jyant, Thomas, and Mike, and everybody here who is present over here.
Thanks, Mike.
Thank you.
Thank you.
Bye.
Thank you.